Good morning, good afternoon. Happy Wednesday to everybody. Thank you for joining me. My name is Tim Watts. I am an annuity sales director, team lead over here at Insurance Agency Marketing Services. I'm joined by Jeff Moore from American National today. Super excited to talk about brand new products from a carrier that you know the name and love their past products. So I'm guessing you're going to really like these current ones. Before we jump into that product and turn the presentation over to Jeff, I do have a few things that I wanted to share about IAMS and why agents love working with us. We'll also have a few polls, and of course, you've got plenty of options or opportunities to answer any questions, ask any questions, and we'll get them answered at the end. One of the first things I wanted to highlight is our best-in-class customer service. When you call over to IAMS at 800-255-5055, you're not going to have to worry about a dial-by-name directory or leaving a message for somebody who's on a 2-week vacation. We're going to get your call answered with someone who's trained and hopefully can take care of you. And if they're not who you were calling for, then we're going to get you taken care of in just one transfer. This is a great service that we provide to agents, and they love the fact that, again, they don't have to worry about those dial-by-name directories. All right, so the first program that I wanted to talk to you about is our new producer program. These are for those producers that are new to us over here at IAMS and based off your production level in your first 180 days. As you can see, there's going to be several different levels that you can qualify for and multiple options inside each of those levels. If you'd like to know where you stand towards your new producer builder, or if you'd like to have a conversation about how to achieve that next level, please give myself or your sales director a call. Another business builders program that we provide for our agents is our referred producer program. Of course, I see a couple advisors on with us today that have taken advantage of this program. Our business on the wholesale side of the industry is similar to yours, and that one of the best leads we could ever obtain is a referral from one of our valued producers. This is why we want to make it worth your while. When you refer someone over to us and they get contracted, we're going to cut you a $50 thank you check. But where the real money comes in is as your referral rights business, you receive an override on that business. Our ownership team, Charles, Steve, Curtis, and Chris, sign check for thousands of dollars every quarter. With that being said, if you can think of anyone that could benefit from doing business with our team, please type their information in that questions box or send me an email at timw@imsinc.com with that information, and I will reach out to them today. Below that is our marketing reimbursement program, which is our most popular program that we offer. For every $100,000 in FIA premium, you're going to get $100 into your marketing reimbursement account. Why this is so popular and lucrative for our advisors is we truly do consider this to be your money. You've got the flexibility on what services, when, and who you use these funds with. We don't tell you which vendors you have to use, but we do recommend vendors that we've partnered with and leverage reduced rate and preferred service on your behalf. We also have our creative team to create a marketing strategy and provide in-house services. If you'd like to know how much is in your marketing reimbursement account or have a conversation about how to utilize it, give your sales director a call at our office. We'd love to talk to you about that. Next is our back office support. This is another way that we add value to your business. This is the core of IAMS and how Charles Hearing founded us over 36 years ago. We want to help the independent advisor work harder, not smarter. We're going to do this with great business building tools and resources. Of course, advanced case design assistance for both life and annuity quotes is an area that we shine in. We're going to get you those illustrations and requests back within 24 hours. Typically, we're going to get that back to you within an hour or two. Submission to commission support is handled by our new business teams. Mackenzie heads up the annuity side, and Michelle is on the life team. They have fantastic teams who work tirelessly to help you get commissioned quicker. We'll scrub your application, submit them on your behalf, do the administrative tracking, and get you updated on the cases as needed. We do this to ensure you get commissioned as quickly as possible, as this is a service that we provide to our valued producers and how we help you grow your business by keeping you in front of those clients while our team handles the back office support. Our website is a great tool for producers to use, and yet another reason to work with us over here at IAMS. Once you're contracted, you're going to have full access to everything that you see on this slide and a ton more at IAMSinc.com. If you haven't registered for the website, it's very simple to do. When we're done with this call, go ahead and create the account. We'd love to see you on there. A lot of great resources are available to you, including illustration tools, online forums, product grids, and product news. Firelight eApps, this is a single sign-on at IAMSinc.com. We've also integrated Luma into that technology as well. Technology is where the industry is going, and Firelight is a top-notch site streamlining this application process. Most of our carriers are on the eApp platform, so you can go onto one site to submit business. It's COVID-friendly, and some carriers are going to eApp only for some of their product lines, and will also offer extra comp for utilizing the eApp platform. Make sure you ask your sales director before you submit a paper app if you can earn more by doing an eApp. Additionally, if you are new to us over here at IAMS, or maybe you've been with us for a while and you need help with logging on to that Luma Firelight site and submitting an app, I want to let everybody know that we have fantastic resources over here on our new business team. Just let your sales director know that you'd like some assistance from Gigi, and she would love to give you a call. She's been in the industry for over 30 years and is a tremendous resource in that space. I just wanted everybody on this call to know, if you haven't done a Firelight eApp, we've got a wing woman there with Gigi to help you get through that process, and we'd love to help you streamline your business with those eApps. That's why we brought Gigi on over here. We do have a full in-house creative team as well to help your practice, and a lot of the items are turnkey and available to you. Many of our sales resources are white labeled, so we can simply impose your contact information and your business logo onto it. Speaking of logos, agency solutions is an area of expertise for our team. If you haven't created a full customized brand for you and your agency, we can certainly help. This is going to assist you with your name recognition, which grows your natural market organically. In addition, digital marketing solutions are an area that's very popular around here at IAMS. We can help you with websites, social media marketing, email marketing, and much more. The internet and social media sites are where the overwhelming majority of prospects go to for information. Making sure that you're accessible and represented in those marketing lanes is beneficial to growing your business. Definitely give myself or one of our sales directors a call when this webinar concludes to see how IAMS Creative can help get the ball rolling for you in those services as well. We've got our complementary marketing analysis. This is what I call our roadmap to success for agents and agency. This is going to be a multi-vertical marketing strategy utilizing both short-term and long-term goals and objectives. This gives you and your sales directors a game plan when you're spending those earned marketing dollars through IAMS, as well as putting your own money towards those marketing programs. You want to be able to track and say, hey, is this marketing strategy working? What's my return on investment? Do I want to provide more fuel to that fire, or do I want to take those resources and allocate them to a different marketing strategy? Again, this is a complementary marketing analysis for you that helps give you a business plan specifically to what marketing strategies you're going to employ, again, both in the short and the long term. I'd love to talk to you and get that marketing analysis set up, again, as well as highlight that not many other FMOs do this for their agents. You know, a lot of folks are starting to cut back and not offer as much resources as they have in the past. We've continued to push forward, and that marketing analysis is a complementary business value add for you. IAMS Wealth Management, we founded over 6 years ago. What we've done is grow this division of IAMS very organically. We've helped advisors become IARs and pass the Series 65 at a very successful clip. Once we have you registered, we'll bring great value to your practice with an incredibly competitive fee structure for both you and your clientele. You'll also enjoy a fantastic technology investment platform. This has been a major growth sector for our business, and assets under management could be a major growth sector for your business as well. We do have our second Life and Annuity Academy happening today. So with that, I'm going to go ahead and launch our first poll while I talk to you about this academy and this opportunity. What these training academies are going to be a fantastic way for those agents that have some experience in the industry and they're looking to put fuel on the fire with additional marketing strategies and advanced sales techniques. We'll also go through product deep dives as there's new and innovative products hitting the market all the time, making sure that you're on the know about what those products are and how they work is going to be very beneficial. You don't want to be a dinosaur selling a product of the past when we've got so many options here. We do cover all of your expenses for these academies, including your airfare out there, so you don't have to worry about getting out there. Once you're out there, you're going to be our guest, so you can focus on, again, around 20 presentations going over marketing strategies, advanced sales techniques, as well as product deep dives. Going to go ahead and end that poll. Appreciate everybody who participated in that. Definitely encourage everybody else to hop on the next one as we proceed through here. All right, we're also ending qualification for our trek to Quebec. This ends June 30th. We've got to get all that business paid by then. So if you're close to qualifying, or if you're able to qualify for one of those top 10 spots and get a couple extra days out in Quebec, definitely give myself or your sales director a call. If you weren't able to qualify for this one, don't worry. We've got another one that just started on May 1st and one that started on December 1st. So 3 total top producer trips that you can qualify for over here at IAMS, just with submitting your business over here and working with us. Lastly, here, before I get it turned over to Jeff, I want to encourage you to connect with us on LinkedIn or follow us on Facebook. This is where we're going to put industry updates, product launches, and industry news out there so you can stay connected while you're on your social medias. With that being said, I am going to go ahead and get Jeff the presenting power. So while he's pulling up his presentation, I do just want to give Jeff a quick shout out. He is a fantastic resource for us over here at American National. And over the last, I'd say about 6 to 9 months, I've really seen how some of their current products offer solutions that you can't really find anywhere else, including one that's got a flexible premium bonus of 11% that you can get for a full 3 years on a 7-year chassis. So that's one that I've been talking to all of my folks about, and have several agents who are working with that right now and writing cases. So I'm super excited to see what Jeff has here for us today. Jeff, it doesn't look like I can see your screen right now.
All right. Now we good?
Perfect. Yeah, you're rocking and rolling. All right, Jeff, talk to us about this Smart Start Accumulator series.
All right. Sounds like a good good idea, Tim. Thank you, and good morning or good afternoon, depending on where you're tuning in from. This is Jeff Moore with American National, and I'm going to try to help us all get off to a good smart start on this Wednesday. What is Smart Start? Well, we launched it yesterday, so it's brand new. I got a couple of Nobel-winning strategies built just for American National. It's in a series, basically three in one. So it's going to offer something for just about everybody. Now it's available in most states. Currently not available in California, New Jersey, and Oregon, but it soon will be. So those 3 states, it will be made available to here in the near future. New York is probably going to be a wild card. Not sure if it's going to get filed in New York yet. A lot more requirements in New York. Some highlights before we get into the nuts and bolts. You're going to see bonus options, premium enhancements, 14% and 20%. You're going to see best entry window, meaning your client's going to get the best buy-in price on their policy on all the strategies they select. Multi-index portfolio allocations, whether it be custom, do-it-yourself, the DIY, or preset, with some pretty awesome blends already pre-designed. So let's kind of look at a skinny of the product first. What I what I call when you get on the airplane, they call it the 30,000 foot level. Let's start at the 30,000 foot level. Issued up to age 85. So make note of that. We got a bonus product here potentially paying pretty high bonuses issued to the older ages. That's kind of noteworthy. Single premium only. The minimum premiums, and companies are starting to raise their minimums. So still got a pretty low minimum, 10,000 non-qualified, 5,000 qualified. Now the maximum premium, right now our published maximum is 3 million, but I've got a plus there next to the million because on our existing product portfolio, especially the FIAs that we currently offer, we're making exceptions every day upwards of 20 million or more. So if you come across a large case, and I was talking with someone yesterday, they've got one that between 30 and 40 million, potentially that's a case we would look at. So something to keep in mind if you've got larger cases. Obviously, a wide array of indexed opportunities that are going to be made available, and we'll kind of dig more into that, so I won't hold us up at this point. Obviously, it's a deferred annuity, deferred meaning deferred taxes. So for those clients that they like the gains in the markets, but they don't like the gains at tax time, this could be a great solution for them, keeping them exposed to the market without the risks and without the taxes. Accessibility of the funds. Even though many of our clients don't take interest out, especially out of FIAs, nice to know you've got the access there if you need it. The contract max maturity is filed at age 100. That's typically for most of our products what we're at today. And then death benefit. This is an owner-driven contract, so everything is going to be based on age of the owner, unless it's entity owned, in which case then we fall to the annuitant. Now let's take a look at the bonus options that we make available. Option 1, or opt out, would be the Smart Start Accumulator. No bonus. Okay, just a straight up 10-year deferred annuity, FIA, no bonus. But as you're going to see, higher strategy rates and caps on the offerings that we make available. Then you've got two bonus options. You've got bonus option number 1, which is opt for a bonus but without a fee. That bonus is 14%. Now these are premium bonuses, okay? Premium bonus. Then you've got the larger bonus option, which comes with a fee. The fee is 95 basis points. That's on the low end. I've seen some out there today on some of the competition spreadsheets as high as 1.5. So in reference to that, I'd say we're on the low end on the spectrum as far as fees. And that's the only option that's going to have a fee. There's no other riders or other build-ins that have charges. So if they want an option with or without bonus, without a fee, we've got two options for them. They want the mega bonus. That one comes at a slight fee. Now let's take a look at the indexes. All total, we got 5 indexes, one of which you pretty much have to have on just about any indexed annuity, right? And that's the good old S&P 500. We've got our traditional, we call it our value cap strategy, which is a point-to-point 100% participation up to a cap. Now that's the only index and strategy of the 5 that have a cap. The rest are all, as you're going to see, are all going to be no cap, no spread, just a participation rate. And we'll start with the Invesco QQQ, but not just the pure index. We put a twist on it. We've got a proprietary index that Invesco built for us utilizing the Qs, but it's called the Portfolio Plus. And it's Portfolio Plus because it's utilizing cash, bonds, and commodities to dampen market volatility and manage it to a 12% cap. Now, that's a pretty high volatility target. Most volatility indexes are anywhere from 5 to 7%. But because of the upside potential of the Qs, Invesco priced it to allow for a higher potential upside, meaning they set a higher volatility range. little bit more tolerance on volatile swings. The second one in the lineup that's also proprietary is the Morningstar Global Wide Moat. VC7 stands for, that's right, volatility control 7%. Now this is more in line with the traditional volatility control metrics. It too uses cash, bonds, and commodities to dampen market volatility. So like its partner, the Invesco, it's also a volatility control option. Both of those manage it on a monthly basis. This one uses the what I call the Warren Buffett approach, or we don't, they do, the Warren Buffett approach, the castle and moat investment philosophy, which you've probably heard him speak on many occasions. Companies that have a wide moat from a competitive standpoint, that maintains somewhat of a barrier to entry for other competitors. Those are the kind of companies, the true value-oriented companies with a wide moat that are targeted in this index. Then we've got the Mark V Excess Return Index. This is one that the industry utilizes quite frequently in both life and annuity products in the index space. We've had this on our products, some of our products here going back to 2021. It's another volatility control index, managing it to a 5% vol target, and it's managed on a daily basis. Again, it's using multi-asset diversification. And then last but not least, the S&P 500 Dynamic Intraday TCA Index. This is yet another risk-controlled index. So all total, you've got 4 risk or volatility control indexes on the board here, and then obviously the benchmark S&P. Now we'll dig a little deeper into each of those. I don't think we need to spend much time on the S&P. We're all pretty well schooled on what the S&P 500 is. So let's start with the Invesco QQQ Portfolio Plus and the Morningstar Global Wide Moat, as those are 2 proprietary indexes to American National. Now, starting with the Invesco QQQ, optimized for growth, but also with an eye on security and protection. So it's using the Qs at the heart of the index, but then it's balancing out with bonds, commodities, and when necessary, cash to manage to a 12% cap on volatility. But again, the heart and soul of it is the QQQ. So with that, let's kind of take a walk through the Qs and kind of orient ourselves as to why the Qs and how they relate to the S&P 500. Now, you've probably seen the commercials running quite frequently on the Qs. They basically are an ETF that replicate the NASDAQ 100 index, which has 100 more condensed index than the S&P. 100 technology, consumer discretionary, growth type companies, both domestic and international. And as you can see, the growth potential compared to the S&P 500 significantly higher on any time frame you look at, 1 year, 3 year, all the way out to 10 year. The Qs, or the NASDAQ 100 in that respect, has far outdistanced the S&P 500. And when we look back over time, nearly 88% of the time on a year-over-year basis, the Qs are going to outperform the S&P 500. Now, it also outperforms the S&P 500 in 2 other metrics, which is kind of laying the groundwork for the idea with the Portfolio Plus index. Yeah, the Qs can perform better, but they also have more volatile swings. In fact, 23% of the time, the volatility on the Qs, or the NASDAQ 100, have been higher than that of the S&P 500. And we're talking about swings to the downside. The Qs, or the NASDAQ 100, experience steeper downdrafts than you typically see on the S&P 500. If we just looked at February of this year, where the NASDAQ 100 or the Qs fell by about 3.5% as compared to the S&P 500 at just under 2% on a downward swing. And it was comparable in April when we had the the tariff announcement on April 2nd, we saw a similar downdraft in the NASDAQ versus the S&P 500. So therein lies the thinking behind the QQQ Portfolio Plus Index. And again, Invesco, since they are the purveyors of the Q index to begin with, or the Q ETF, they were the ones that we went to initially to build this for us. So we take the performance potential and the volatility of the Qs, and we say, okay, I want the growth. I just want to kind of dampen some of that volatility. So we add in some government bonds, 5-year and 10-year bonds, and we add in some commodities. And basically, we smooth out that rough ride in terms of volatility, giving us good, smooth performance, and over time, pretty solid performance. In fact, if we look at it, and obviously this is a new index, it came out in May of this year, so it's brand new, only at Anico. But if we do just a simple 10-year back test, the average return of this index over 10 years is 11.6. And on that prior slide, we were looking at the 10-year return on the Qs themselves was about 15, 16%. So you're giving up a little bit of the upside, but you're getting a much smoother ride because you're avoiding a lot of that downside volatility. So overall, for a 10-year potential return, just under 12%, not too shabby. Now let's take a look at the other proprietary index with Anico. Actually, I'm sorry, getting ahead of myself. One more note on the Invesco Qs before we leave it. How does it break out for that smooth ride? Well, surprisingly, it can still deliver the results we were just looking at on the prior slide with only a small portion actually being in the QQQs. Now, this is based on that back testing that they did using their pricing and their model. What would the asset distribution have looked like in this index over the last, this goes back to 2005, so this takes it back a bit, but 13% weighting in the Qs versus about a third in the bonds, 2/3 actually in the bonds, and about a third or a quarter thereabouts in commodities. So pretty good weighting in the diversification asset classes to smooth out that performance, yet not interrupting the actual numbers themselves. It still delivered a pretty good number over that time span. Now we'll take a look at the Morningstar. Now this is a science-backed strategy too, because it's using not just pure equities, but again, it's balancing it out with treasury market bonds, basically, and commodities to smooth out the performance, minimize the volatility, and provide a good long-term time-tested return. Now, this is a new index. Morningstar built this for us in April of this year. And what you're going to look at here is you're going to look at a base index, which at launch today, it's sitting at about 60%. Okay, 60%. And again, these are your value, your mostly larger cap companies with that wide moat, less volatile than what you find in the Nasdaq. So a larger weighting on the equity side here, 60%, with about 20% in the bonds and 20% in the commodities. And you'll note in the commodities, it's ex precious metals, does not include precious metals. That's probably the most volatile. That and oil are probably the two most volatile areas of the commodity basket. So this is more of a broad commodity basket, excluding precious metals. So you've got a pretty equity-centered approach here. And this is the base index. As noted at the bottom of the slide, a risk control overlay is applied to manage to that target volatility of 7%. So provided volatility is below that 7%, it can lever up to potentially 250% of the base index that you're looking at. So it can lever up on the equity side. And if volatility is getting a little higher, then it can lever down on the equity side and lever up on the bonds and the commodities. Now, the commodities do have an implicit cap on a weighting of 50%. So if it does lever up on the commodities, it won't lever up over 50%. But it just shows you there's a lot of science involved in this and a lot of active management involved in this to manage to that volatility level. Now, how is it actually performed? Well, again, it's hypothetical. We're back testing, right? But if we look at, there's your annual returns based on the how the index is built with the base index and the leveraging that they can do. Pretty decent returns. 2023 more recently, not bad in a market climate that we had, which was pretty volatile with rate swings coming out of 2022. And I'll point you to 2022. We saw downswings in the market of nearly 30% on the Nasdaq and close to that on the S&P, and yet this index would have performed at maybe a negative 7.5. Not too bad, not too shabby. And over 10 years, annualized return, not too shabby either, over 8%. So you've got a good, stable index here, good opportunity for growth. Maybe not quite as high as the Qs, but still not a laggard in any respect. Now we got the S&P Mark V Excess Return Index. Not proprietary to Anico. There's several companies out there utilizing this, both in the FIA space and some of them on indexed universal life. This is a multi-asset index, three major asset classes: equities, bonds, and gold. Now for equities, strictly the S&P 500. For bonds, strictly the U.S. government 10-year treasury. And for commodities, the only commodity it uses actually is gold. So you can well imagine the first half of this year and last year, that asset class has been a large component of this index, as it's been a pretty positive performer over the last couple of years. Now this manages to a 5%, much lower vol target, and it will go to cash if necessary to dampen volatility. And like the others, it can use leverage. It can lever up to 150% on any one of the asset classes based on market signals that it's seeing and based on volatility levels. And this one manages really tightly because it rebalances daily. So unlike the others we talked about, the other three volatility indexes, the next one we're going to look at as well, they all manage to a monthly vol target. This one rebalances daily. Last but not least, we got the S&P Dynamic Intraday TCA Index. Now, that's a mouthful. Again, it's not proprietary to Anico. This too is out in the industry. It's newer. It's been around since August of 2023, but it's an index that's exposed 100% from an equity standpoint, 100% only to the S&P 500. Doesn't look at any other stock indices or any other asset classes. And it's going to manage to a higher volatility target, 15%, but it will rebalance up to 13 times a day. So on this one, this is also a daily, rebalance up to 13 times a day. This one is the most frequently managed or actively managed vol index out there. Now it's new in the marketplace. There's about a half a dozen or so companies utilizing it in their products, but already there's just shy of 6 trillion in assets in the industry in this index. So a lot of companies are starting to turn to this in lieu of just using the S&P 500. The managers of the index, they look for trend signals throughout the day to help guide them in rebalancing it. Now, because it's a hands-on, actively managed index throughout the day, they manage to a very high vol target of 15%, because they want to go as high as they can on the positive return side and basically outperform the underlying S&P 500 whenever possible. But if the volatility gets too high, they could potentially go to cash. But regardless, when they're in equities, it's only going to be the S&P 500. Now, doing a back test, because that's all you can do, looking back 15 years, 2009 through 2024, the annualized return of the TCA index versus just the basic static S&P 500 you're looking at 1218 versus 972. So about 2.5% better on the TCA on an annualized basis going back 15 years. So in up markets, it can definitely do better. Now by the numbers, again, you're looking at zero exposure other than cash to any other asset class, strictly the S&P 500. Because it too can lever up to take advantage of market swings. The average exposure to the S&P is 125%. The upside cap, it could lever up to 250%. So if any of you are investors and you utilize some of the levered ETFs out there, I know you all probably know the SPYs, the SPY. That's the ETF that mimics just the S&P 500. No levering. But then there's a plethora of S&P 500 ETFs that can lever anywhere from 150% to 250% of the S&P. Well, that's essentially what this is doing. This is giving them more than 100% exposure to the S&P, potentially as much as 2.5 times. And kind of a noteworthy stat, they did that back testing for that 15-year period that I shared with you. And looking back 15 years, year over year, this index is positive 75% of the time. Now that's slightly better than the S&P over the same time frame. It was positive 73% of the time. So this does outperform the S&P in up markets. We don't really care if it doesn't outperform it in down markets because we're talking index products and there's no downside risk. Okay, now that we've kind of covered the indexes that we offer, let's talk about allocation to the respective strategies and some of those Nobel winning portfolio optimization techniques that we have in place. Let's start with portfolio allocations utilizing the pre-selected options. Now, before we do that, just kind of a quick walk through or walk down memory lane on the indexes that we offer. Now, there's the S&P 500. That's the point-to-point with a cap. Okay, that's our value cap strategy. And then here are the 4 uncapped, no spread, no fee, participation rate only strategies on the respective indexes we just talked about. We'll start with a conservative portfolio. Conservative portfolio, you see, has 20% allocated to the declared or fixed strategy, and then nothing in the S&P 500 itself, but then it has 20% allocated to each of those volatility control strategies and indexes we just talked about. The dynamic intraday, the Mark V, the Qs, and the Morningstar Global Wide Moat. Now we turn to the moderate portfolio. Here you've got nothing allocated to the fixed account, but now you're going to pick up exposure to each of the indexes themselves. You've got 20% in the S&P 500, 25% in the TCA S&P 500. You've got 10% of that Mark V, 20 in the Qs, and 25 in the wide moat. The aggressive is probably the more concentrated bet. There you've got nothing in either of the S&P 500 options. You've got 30%, actually you do, I'm sorry. You've got 30% in the S&P 500 TCA. You've got 40% in the Qs and 40% in the global wide moat. And then last but not least, you see the customized, and there's nothing in there, and that's because the client decides. That's the, as we would say, the Home Depot or the Lowe's, the do-it-yourself. That's the do-it-yourself. Select whatever amount you want in the fixed account or any of the other indexing strategies. Now, regardless of which one of these you select, you've got the freedom to reallocate every year, regardless of what you started with. And you can go in and out of any of the portfolio pre-selected allocations, in and out of them, back to them again in the future with no restriction. Unlike some of the other companies out there, if you leave a pre-selected portfolio, you typically can't return to it. Now, what am I getting price-wise? Well, let's start with the Smart Start Accumulator. This is the no bonus option. Now you're going to see slightly higher rates. We'll start with a conservative rate portfolio. This is the pre-selected. You got a 5% fixed account, and then there's the participation rates on the various uncapped strategies available in that portfolio. Not too bad. We get to the moderate rate. You've got pretty much the same participation rates on the uncapped strategies, and you of course pick up that cap strategy on the S&P 500 with a pretty nifty 11.5% cap. You get to the aggressive portfolio, and obviously it's a more concentrated bet, slightly higher participation rates than you have on the other two managed portfolios. Now you get out to the custom rate, the do-it-yourself, and we're not charging a fee, but as you can see, the cost to the client is the participation rates or the cap a little bit lower than they are on their pre-selected portfolios. Now, that comes for a reason. With the pre-selected portfolios, obviously because we can control the flow, we've got a better beat on pricing, so we're able to offer higher cap, higher participation rates on the uncapped strategies if they're selecting one of the pre-selected portfolios. So that's the benefit. I'm not charging the fee on the customized. I know some companies do. It's just coming out of the pricing on the participation rates or the cap. Again, freedom to reallocate every year. Now we turn to the Smart Start Accumulator Plus. These are the bonus options. Okay, as noted at the bottom, you got the premium enhancement without a fee, that's 14%, and you got the premium enhancement with a fee, that's the 20% bonus, costing 95 bips. Now, obviously, the pricing as far as the cap and the participation rates on the uncapped strategies, well, yeah, they're going to be a little bit lower than the ones we just looked at on the non-bonus option. And obviously the reason for that, we're front loading some of that participation rate, some of that cap, we're front loading it in the form of the bonus. They're getting a lot of those index gains right up front the first year. So if we look at the conservative rate portfolio, you're about here, you're probably about 20% lower on the participation rates than you were on the uncapped strategies on the non-bonus product. And the cap, well, you don't have the cap strategy here. If we look at the moderate rate strategy, the cap's going to be about 4 points or so less. And again, the uncapped par strategies, they're going to be about 20% less than they were on the moderate portfolio with no bonus. And the same holds true on the aggressive rate. So you're giving up about 20% participation rate and a few points on the cap to get that upfront performance in the form of a bonus. And that's significant upfront, talking 14 to 20%. Last but not least, we got the custom portfolio. And here too, you're getting a lot of that upfront with the bonus. So your participation rate's a little bit lower. Cap here is about 3 points lower than it was on the custom portfolio, custom design portfolio, no bonus. But again, still with the freedom to reallocate each year. For the best pricing here on the bonus option, probably comes without a doubt. The aggressive rate option is going to give you the best pricing based on today's rates. Now, regardless of whether they go with the no bonus, the bonus, whether they go with a custom design, or whether they go with a pre-selected portfolio, all options are going to offer the client 90-day best entry. So that means the policy's issued. We're going to wait for the first 90 days to pass before we determine the actual buy-in point for the client. Now, it's still going to be retroactive to policy issue. So they're not going to lose interest. They're just going to be guaranteed the best index buy-in price at issue. We're going to wait 90 days to determine that buy point, but it's going to ensure your client gets the best price. So the old adage, buy low, sell high. That's kind of what we're doing here. No additional cost, automatically included. Now let's talk about policy liquidity. It's going to vary based on whether they go with a Smart Start accumulator with no bonus or whether they go with one of the two bonus options. We kind of divide it into two options when it comes to the liquidity. If they go with the no premium enhancement, which is the Smart Start accumulator, or they go with the Smart Start accumulator plus with no fee, that being the 14% bonus, then the penalty-free access all years, including year one, is 5%. So a little bit less than what we're accustomed to, but still they've got liquidity day one. Now, if they go with the premium enhancement with a fee, that being the Smart Start Accumulator Plus at 20%, they have a 10% penalty-free access, all years, including year one. Additionally, if they don't take that penalty-free in a given year, they can stack it into the next year. So if they didn't take the 10% penalty-free in 1 year, they could increase the next year's penalty-free amount by 10% or stack it at 20%. Now that's the maximum stacking, as it were, 20%. So let's say in this example, let's say they took 5% in the first year. Then they could take 15% the next year. And they could do it in future years too. If they miss a year, don't take anything out, then the next year they could stack it at up to 20%. So any year where they've got carryover from the prior year, they can stack it. Again, the fee on the 20% bonus option that offers this is 95 bips. Surrender charges and also bonus or premium enhancement recapture schedule. Now, first we'll start the top schedule, which is the surrender charge. Obviously, it's based on contract year or issue date. In most states, it's a 10-year surrender charge starting at 9%. In California, it's a 9-year surrender charge starting at just under 9. And then the premium enhancement recapture, regardless of whether it's California or outside of California, it's a 9-year bonus recapture schedule. Okay, it starts at 100% outside of California. In California, it starts at 90%, and then it ticks down by 10% per year. Now, currently the product is not approved in California, but it soon will be. It's actually the states that it's not approved in currently are California, New Jersey, and Oregon. Disregard the Idaho. We did just get it approved in Idaho on Monday, so it is released and available in Idaho. Just California, New Jersey, and Oregon. New York likely will not be available. Now, regardless of the surrender charge and the contract recapture schedule for the bonus, if you'll note in the highlighted section there at the bottom, death benefits are going to be the greater of annuity value or minimum guarantee surrender value. Bottom line on death benefit, bonus recapture and surrender charges do not apply. On RMDs, they also don't apply. So this is RMD friendly and death benefit friendly. So back to my earlier comment when we started this morning, that it was noteworthy that we offer a bonus at the older ages. Well, it's noteworthy when you consider that we offer a bonus at the older ages, and that bonus is included without recapture at death of the owner. So that's what's noteworthy about the high bonus, especially when it comes to the death benefit. How about chargebacks? Oh, whoop, I'm getting ahead of myself. Before we get chargebacks, three riders that are automatically included in most states, except of course California. Confinement, if they're confined in a nursing home, skilled nursing facility, convalescent care, and the like, or if they're disabled prior to age 65. Those two riders are waivers, actually, waivers of surrender, and recapture charges. They're available in most states, except of course California. And then in pretty much all states, we have the terminal illness waiver. Diagnosed to a terminal illness, expected death within 12 months, we waive all penalties. Okay, now let's talk about commission chargebacks. And kind of goes back to that death benefit comment. This is noteworthy. No chargeback at death ever, not even in the first year. Now that stands in tandem with our other indexed annuity offerings that we currently have. None of the FIAs that we offer today, including this new product series, will charge back commissions even in the first year at death. They're the only products we offer that have no chargeback at death in the first year. Also noteworthy, on partial surrenders, there's only going to be a full surrender, a full chargeback of commissions if they do a surrender greater than the penalty-free amount in the first 6 months. So if the client did a partial surrender greater than the 5 or 10% allowable in the first 6 months, then yeah, there would be 100% chargeback for the overage. But if it's in months 7 through 12, the back half of the year, then only 50% of the commission on that excess amount would be charged back. Most companies, it's going to be a chargeback, full chargeback in the first 12 months, anytime the client incurs a surrender penalty. Training. Yeah, we've got our all-encompassing training on the Anico website, but we also have standalone training now available for all products, including this new product series. If you utilize Reg Ed, which is also, there's a link on our website under the agent training, you or your agents can access the standalone training for just this product, so they don't have to repeat all the other product training. Product brochures, we've got 2 that are both client approved. One we dubbed the agent brochure because it goes in a little bit more into the weeds in terms of the strategies, the indices, and the information that you, the advisor, would want to know. And then we've got one that's maybe higher level, a little simpler, doesn't get quite as deep into the woods for your client. It's called the client brochure. Both can be used with your clients. And then we've got 2 ads available on our website. You can go in there. Once you log into the website, you can go to the personalized ads under agent resources, and you can customize them right there, Johnny on the spot, and have them ready to go. You don't have to send them through approval. You'll have a PDF ready to utilize for your own use. Finishing up with illustrations. When you go into the illustrations, the Smart Start and Accumulator Plus and Accumulator, they're all on there now under the Fixed Indexed Annuity options. If you select the Smart Start Accumulator, it'll just go straight to the allocations. But if you select the Smart Start Accumulator Plus, you'll get that first box there on the bottom left corner, basically giving you the option to select the low premium enhancement without a fee. And that's the 14%, or the high premium enhancement with a fee, that's the 20%. Then on the actual allocations, on the right there, if you want to do the custom do-it-yourself, or your client does, you would select none for allocation blends. However, if they want to select one of the pre-selected options, moderate, aggressive, or conservative, it will autofill that screen on the right. It'll autofill those weightings in the respective strategies. And if you've forgotten what they are, once you select moderate or aggressive or conservative, you can click on that allocations button there in the middle. It says allocations, shows the funnel. You can click on that and it will show you what the weightings are for the portfolio that you selected. Now, there are certain states, even though all the strategies, including the pre-selected portfolios, they're all available in every state that the product is sold. Okay, right. So right now, every state except the 3 states that it's not available, you can utilize all of the indices and strategies. However, there's about several states here at the bottom highlighted that you cannot illustrate those strategies in. That would be Alabama, Colorado, Maine, Iowa, New Hampshire, Ohio, Rhode Island, and West Virginia. So those strategies will be grayed out in the allocation box when you go in there if it's in one of those states. However, those allocations are still available on an actual policy. Now, if you're wanting to run an illustration that shows those allocations, you can just utilize Texas, since we are a Texas-based company, and just let the client know that you're able to offer these in every state, and you know, and just run it as a Texas illustration. Application. I know most of you, as Tim started off this morning, most of you will likely be utilizing Firelight as it is the only way to go today on apps, e-apps. But just to kind of give you a snapshot, it'll be similar in the Firelight experience as well. You'll have an allocation section for the do-it-yourself, basically the customized allocation, and you'll have an allocation section with the predetermined portfolios. It'll look similar to this. This is a snapshot from the paper app, but it'll look similar also in display on the Firelight app as well. Sales idea before we close it out, and then we'll open it up for questions. I call it recovering and harvesting losses. In the volatile years that we've had recently, many of our clients may have some losses, whether they be in variable annuities, possibly just directly in stock market investments. I call it no pain, only gain as our approach to making your clients whole. You've got a client with $100,000 investments or cost basis originally. They take a 10% hit, and now that investment is worth $90,000, leaving them with a $10,000 hole in their pocket. What can we do to make them whole? Well, we can use the Smart Start Accumulator Plus to recover and harvest those losses. Let's take, for example, losses coming from another annuity, whether that be surrender penalty if they need to leave the annuity early, or maybe it's a variable annuity that's got both investment loss and possibly some surrender penalty. Well, this is kind of a neat idea, but it's valid. That cost basis of $100,000 carries over to the first policy they do a 1035 transfer into. It won't carry over for the second one, obviously, because you'll now have a new cost basis. But when they transfer over a policy with a loss to a new policy with Anico, they'll retain that $100,000 cost basis such that the first $10,000 that they take out of the Anico policy comes out tax-free until they get back to their cost basis of $100,000. That cost basis is not affected by the bonus that they obviously get in the new policy with Anico. So the bonus helps them recapture some or all those losses, but they can use that cost basis from the original policy to their advantage if they're taking money out and avoid taxes. Now, let's say it's money coming out of the stock market directly. They sold some losers in the market, took their tax deduction, and whatever it was, if it's over the tax deductible amount, it goes into their tax deductible carryover, but they still register it as a tax deduction today or for future tax returns. But even so, we still give them that bonus. It could be potentially recover that loss. So they get their tax deduction, they harvest that, and they make up some or all of that loss with the bonus. Not bad. And for you, the writing agent, all business you do in any of our indexed annuities, this product series or any of our other fixed indexed annuities, we've got a nice bonus. It started January 1. It's a writing agent only bonus. It's retroactive day 1 to January 1st, all the way through the end of this year. We pay out the bonus quarterly whatever bonus level you're at each quarter, we're going to pay out that bonus percentage retroactive on all your business. And if you look out there at the far right end of that bonus spectrum, if you hit 10 million with us by the end of the year, that's another 1.5 bonus on all your business. So if I can be of assistance to you as well, I'm kind of a second layer of support. You, of course, got the very capable people there at we've got the very capable people there at IMES, and I apologize, my display changed a little bit there uh, to help you. But there's my contact information there on the right. Um, Hopefully it's coming through okay. I may have lost the regular screen share, but um, if you're seeing it, my contact information there is on the left, and the field support team is kind of my bank of internal support. When you can't reach me or can't reach the capable folks here at IMES, you need an ANACO support. You'll never get voicemail with field support team. You'll always get a live body. There's your new business team. And if you've got a case that needs special handling, you can always escalate it to the annuity new business manager. If I can assist you in any way going forward, please don't hesitate to reach out to me. I'm going to flip it back over to Tim, and we'll open it up for questions.
Yeah, no, thanks, Jeff. Really appreciate all of that. Very detailed. I had written down 3 questions as you were going through the presentation, and then you answered it. So we do have one, and that is, which carrier is this? And that is American National is the carrier here. So we are up on time. So any other questions from the group, we'll get those answered as I give them a buzz and get you this recap. Of course, we'll get you some information and marketing material for this brand new product. So, Jeff, thank you very much for presenting. Really appreciate it. Any last words here before we let everybody go?
We did do a broadcast webinar yesterday for all agents. It was recorded. So anybody that wants, because I don't know if this one's recorded or not, but anybody wants a recording from that one, I should have that recording later today. We also have a product training that goes about 8 minutes. I can make either of those available to you. You can reach out to Tim or to myself, and I'll be glad to get those sent out to you. Appreciate your time. I know it's valuable. Appreciate your interest and your business. Thank you, everybody. Have a great Wednesday.
Awesome. Thank you. Have a great one, guys. Bye now.